Give me a second. Okay, fine. Last class we discussed the circular flow of economic system and how economic system works and how a financial system is very important for an economic system. And then what are the components in a financial system. So we just had an overall idea about the economic system as well as financial system. So you might have now a very good mind mapping. So we won't be able to, or like we won't be missing anything out of the context. So whatever we study here, it's better if you can always if you can always link to that broader perspective. So this lectures today will be targeting on interest rate analysis, right? So here, if you can see, our second discussion area is interest rate and the financial instruments and financial markets. So this is our title. Into that title, okay, we can see into three areas these interest rate aspects. So one is the understanding interest rates, and then how this interest rate behaves, and when it comes to risk structure and term structure, what are the the special aspect we have to look into that when we talk about interest rates. So those are three areas I want to give a focus on that. In your previous lectures, you might have done some extended kind of calculations on interest rate. I'm not sure, but here what is our expectation is you should be able to understand what is interest rate all about and how that influence in your decision making. So that is the focus of these today's discussions, right? Okay. Now, as I said, now first one is understanding interest rate. Into that, we would be seeing like, okay, valuing monetary payments now and future, right? That's one aspect. And how we are going to measure an interest rate, that's the second one. And into measuring, we will be having simple present value as well as yield to maturity. These are two different kind of basic theories that have you should be able to apply wherever that is necessary. And then the distinction between interest rates and returns, thereafter maturity and the volatility of bond returns, basically interest rate risk I'll be talking about, then a distinction between real and nominal interest rates. So that will be useful for in our monetary policy analysis in later stage. So this is the coverage of the first part, and we would be looking at the second and third. If most probably I won't be able to finish this discussion within today's lecture, so we will be sometimes continuing for next day as well. So anytime please interrupt me if you have any questions, or if you want to link with any other things, of course, okay. And if you need further elaboration, even I can, next lectures also I can take up those discussions points. So are you okay with me? So do you have any issues in the last discussions, or just before starting this one, like we can just touch upon and go, if everything is okay? Anybody wants to say anything? Rangana, is that okay?
Okay, sir.
Yeah, thank you. So we'll go ahead with our discussion points today. Now, when it comes to interest rate, we should be, able to understand from the basic point of view. Actually, like if you take this economic system, we discuss. Okay, finally we arrive to financial system where we have two units, right? Basically, so one is surplus unit, another one is deficit unit, right? So So what happens is in our economic system even, so we can think of like we have two agents in a basic economic system. One is household, another one is firm, right? So these households always some part of the people, okay, maybe some individuals, right, they may be having more money than they need currently, right? So excess, so they would be looking at some avenue to park their money as an investment. So they will have saving, and then they wanted to have some investment. So the problem is, like same times the firms need money, right? So there should be a lending, right, to, you know, kind of resource allocation to activate the production mechanism. So lenders in the history, based on the textbooks I'm telling about, this history, as the textbook says, okay, like thousands years back even, this credit is there. Like that means like we can understand even, always there would be a deficit unit, there would be a surplus unit. So not only today, maybe if you go back to 1,000 or 5,000 years even, the same scenario was there. That's what textbook says. So but however, when you say lenders, always we think, okay, these are the bad people, right? So why we are thinking like, okay, so because like some people always, you know, maybe with resources, and some of others may not be having that kind of resources. So always the blame is there with the lenders, okay, yeah, you are bad people. So but however, when it comes to resource allocations, if you don't have money, you have to borrow. You can't avoid that, right? So nowadays, can you think of an economy without lending? No, it's very difficult, because every economy you might have, or you can have a capitalist economy, or like maybe a communist, okay, whatever things, okay, maybe hybrid, but still everywhere you lend. Even if you say, okay, lending is bad and charging interest is bad, no, you are doing it with different names, right? So without that, your economy cannot function, because it's ultimately, we know, we are trying to satisfy unlimited wants and needs with limited resources. So capital is one of the limited resources. So then without that, you can't see any economy, or that means without lending, you cannot see any economy in this world, even within individual as well. But you have to, you know, manage with the finance with the availability of the credit. So uh, but still, even individual perspective, if you are going to borrow from a person, even if he charge a minimum interest rate, we are going to say, okay, this guy is charging interest rate, he's a bad guy, right? But apparently we have to live with that, because without any lending or credit facilities, we cannot move forward, right? So that's a kind of introductory session, so for you to understand, okay, credit is part and parcel of a financial system. As I said earlier, the credit is one of the mechanism we used to have to allocate resources, right? If you have this capital as a resources, what is the allocating mechanism? It's a credit, lending, right? Okay, so now so without lending, as I said, like, okay, now as I said, okay, like you have the surplus unit, you have deficit unit. So definitely, if you want to have a proper allocation, or like effective allocation of resources, definitely you should have a way to pump the money where that can be used effectively, right? Now the problem is, I'm serving today. How I serve, I postpone my consumption, right? So I have opportunity cost, right? So I have to charge interest on you, right? And you can make that capital in a productive way that could produce a benefit better than what I get. So then, so both parties are in a situation where you can win, right? It's a win-win situation. So then if that is the case, this flow will be there always, right? So it's a never ending. So you cannot think an economy without this one. You can remember, because like we always used to say, rich people are getting richer and poor people are getting poorer, whatever happens, right? So that is the phenomena we always look at. That level of poverty may be vary, but here may be $2 per day, but US may be some of the $10 per day. There's no definition. What I'm saying is, level of poverty may be vary, but you are still having poverty. And if you see the trend, right, in historical trend, the disparity, income disparity is always increasing. In other words, like rich people are getting richer and poor people are always getting poorer, right? So why it's happening? So because like you might have heard like vicious circle of poverty, right? So that means the poor people always within that cycle. It's very difficult to come out from that cycle. But making use of that, these rich people always accumulating wealth, right? So continuously. So this even most of the countries you could see the disparity is growing, even though we say like the GDP is growing, right? So we are getting more product and services, but still, if you compare rich and poor, the disparity is getting worse. Okay, so can anybody say like, okay, why these poor people are within that cycle? They are unable to come out from that poverty. Whatever we do, if anyone can say anything? Any idea? Chaturanga, if you can at some point on that.
What I think is, sir, I think they don't have enough money to save or for future consumption. So whatever they earn, it will be used for their consumption. So nothing will be there to save. That's what I think. That is one major thing. I think they are still in that same category as poor.
Yes, I agreed with you. Like perfect. The thing is, as you said, because these poor people now they always have the low income, right? They always have the low income. So if they have the low income, it's very difficult for them to save, right? So whatever they earn, they consume, right? So they have no option to save some money, right? If they can't serve, so if they cannot have investment, right? So to have additional investment, you should serve some money. If you can't serve, you cannot have additional investment. So if you cannot have additional investment, so you won't be able to get additional income. If you want to have additional income, you should have additional investment. But if you don't have additional investment, then definitely you are not going to make any additional money. So then definitely your income will be low as previous. Then again, low income, low serving or no serving, and then no investment, then no return. So then you have low income. So then you will be always within the cycle, right? That's a poverty vicious cycle, right? So now the problem is, can anybody tell us where can we break this one? If you want to bring the people out of the poverty, where can you break? Vidura, if you can add something on that. Or Rangana? So
if we can give them external finance, they can use that money to start business or generate new income earnings.
Perfect. As I said, actually, like where can we break? Actually, like they have low income, low serving, so low investments. So then, or no investment. So again, they are going to have low income. So we are, as you exactly like correctly said, where can we break this connection is on investment, right? If you have low investment, you cannot have more investment. So then somebody should lend them to have more investment, right? So then, as I said, we can break on that side. That's what we always talk about, financial inclusion. So bring all these marginalized people into the financial system, lend them at a lower rate, and bring them up little out of poverty. So that is the only point we can break. But whether that's working correctly, it's different questions, because like they have to balance their risk and or like risk and return, or in the sense like cost and benefit. Maybe if you take if you think about like, okay, a plain vanilla way of thinking, so that means interest, cost and return, what they are getting is maybe high interest rate lending, so they are unable to come out from that sometimes. But the basic concept is correct. We have to finance them, as you said, additional credit, so then we can, some extent we can try to bring them out from the poverty cycle, right? So here, that's what I said, always the credit mechanism will be there. Then, right, you cannot avoid in an economy. So that's a basic way of allocating resources, because always you have two unit in your economy: surplus unit and deficit unit. Okay, so only thing is, so you should be able to appreciate the opportunity cost of lenders, and you should be able to pay a return for them. Because if I forego my consumption today, that's what I'm saving money. But if you're not enough to give us kind of remedy, so then I won't be able to serve. Clear? Now, if you take an example now, during even Sri Lankan past years history, if you see, people don't want to save, because the interest income they were getting from these deposits was too low. That's what like normally even economy or like regulators try to reduce the or reduce the interest rate. You cannot go beyond some level, right? If you go beyond that level, even the surplus unit will be affected. Take an retired person, right? Let's assume I'm a retired teacher. I park money in a bank deposits, right? Thinking that, okay, I will be, paid by a lucrative amount, so that I can look after myself, medicines, living costs, rental and everything. If suddenly, if you reduce the interest rates, what will happen to my life? So I don't want to serve anymore, right? So just I want to leave it today. So every time we have to think about the opportunity cost of lending as well. So we have to appreciate, and that is the way we can bring any person out of their poverty or like low level living standard. So when it comes to interest rates, so it's three purposes. One, that link the present to the future, right? As I said, now today you're going to lend to me, right? So what is your expectation after 1 year? So you will be thinking, okay, today if I am lending to you $1,000, so then after 1 year you should be able to pay something more than that, and how much? So you have to link this today's you are lending with the tomorrow's repayment. So where you can use interest rate. So interest rate is the mechanism or underlying factor that give you these linkages. And other hand, okay, so if I'm a lender, I should be able to understand what will be my future rewards, right? One is you are going to link the present value to the future value. Second, you should be able to understand the future reward of mine by lending it today. right? And same thing, the third, if I'm going to borrow, the other's point of view, deficit unity. If I'm going to borrow today and I have to pay it later, so what would be my cost? Because like, okay, I'm not earning anything, but I want to consume today and I'll be paying in a later stage. So I consume before earn. So what is the cost of that? So this all three factors, all three aspects are answered by interest rate, right? So when you understand the interest rate, you have to have the understanding in three fronts. So interest rate that links to the present to the future, or maybe that may be working as a reward to the lending, or that may be working as a cost of borrowing. So whatever the case, when you understand the interest rate, you should think of all these scenarios when you make the decisions. Is that okay? Is that clear? So always think your interest rate behavior with those economic factors behaviors or agents behavior, right? Okay, so then when you value, as we discussed, okay, three factors or three aspects we have to look into, but same time when we value a monetary payment now and future, what we are going to do, that's the first question, right? So then we should be knowing, okay, if you know the present value, today's value, if I'm going to lend $10,000, so what will be the value after 1 year? That's a future value. Or like if I'm going to get 10 bucks or 10,000 bucks from after 1 year, then what would be the value today? We should be able to value those monetary payments now and future. And also like when you make the decisions, okay, you should be able to understand how and why is the promise to make a payment on one day more or less valuable than promise to make it on different date, right? So when you talk about a lending, okay, today's payment or maybe 2 days later, so what's the difference, right? What is the value of these two payments? You should be able to understand. That's what I have mentioned here, value monetary payments. So always we should be able to value. As a bankers, I think most of the participants here are from banks, I believe. So then always whenever you change even one date, you have to think about your interest rate, right? I think when you recommend something, right, we should be able to, you know, explain the background and the rationale based on the interest rate impact, right? I hope you understand. Am I too fast or is it okay? Vidura, is that okay?
Yes, sir. Okay.
Thanks. Now here, like, first of all, measuring interest rate, you might be knowing this one. Definitely I know, but I just want to recall this one in your mind. So we always used to assess the present value, right? What is mean by present value? A dollar paid to you 1 year from now is less valuable than a dollar paid to you today. Now, if somebody asks you, right, okay, I'm going to give you like 10,000 bucks. Do you want it today or like after 1 month? What would be your answer? Anybody? Maybe
Today,
yeah, thank you. That's today, right? So whatever happens today is more value than a later stage. Sometimes I would be asking very simple questions. Don't shy away to answer those questions, because like it's kind of, I want to have a, you know, more interaction, so people tend to ask even difficult questions, so that's better, right? So thank you. So then it's always getting the money earlier is better than getting the money later, right? Why? If you get it today as in practical sense, like, okay, you get it today or 10,000, so you can park it in a bank FD account that will earn some interest, right? Maybe if you're going to deposit for 1 year, so 1 year you will have another interest component as well. So always it's better if you can get it early, right? Okay, and if you think, as an example, you got a 20 million lottery. The question is actually, like, there are lotteries. I don't know whether it's in Sri Lanka. If you go to US or Australia, so you will have that options. They will ask you whether you need 1 million today, or like if you want to get that 1 million in yearly, not 1 million, maybe 1.2 million, kind of 100,000 every year, something like that. There may be patterns of distributing those rewards. So in that sense, you should be able to differentiate these two payments, and you should be able to choose which one is better, right? Sometimes getting 1 million today may be worthier than getting 1.2 million after maybe 6 years, right? Something like that. So you should be able to compare and contrast and take the call on that, which one is beneficial for you. So when it comes to present value, so whatever the money you get throughout the periods, you have to calculate the present value. What is the value of today? Well, what is the value of that money today if I get it today, right, rather than getting for several years, right? That is called present value. That's called measuring interest rate, right? Now in this simple example I have given, now if you get 100 bucks today, that's 100 bucks. But if you are going to get it after 1 year, right, let's assume I get 100 bucks today, I deposit in an FD for 1 year. The FD give you a 10% return. So then what will happen? So you can see in 1 year's time, your FD can be liquidated at 110 bucks. That means within the 1 year, with your investment 100 bucks plus 10 bucks you earn as interest, now you got it 110. So now it's easy for us to like think, okay, today's 100 is like equal to after 1 year when you get 110. So now present value means we think if I get like 110 after 1 year, what is the present value, today's value of that 110 bucks, right? So I have given the calculations. So then in a 2 years, that would be 121. In a 3 year, that would be 133 bucks. And if it is an n year, so then you can see the final formula, 100 bucks into 1 plus I within the bracket power to n, right? This is the calculation. So this is very basic calculating present value. So this is the way we always measure the interest rate, right? If you know today's value, if you know 1 year's down the line, what is the value of that today's value? If you put in this formula, you will get an interest rate. Is it okay? This is a basic one. I 100% sure you understand, and you could recall this. If there's any issue on that, Raja Karuna, you have any issue? Dilshani, is that okay? Oh, I didn't hear from anybody. Ragana, is that okay?
Okay, sir.
Okay, thanks. I think it's better, like everybody can have say on this, so we would be, like it's kind of, virtual. We should have always a kind of discussions. Otherwise, if I'm just explaining this one, it's very basic, I understand, but you should have give me, some kind of hint as well, whether we are following or not. Otherwise, I won't be able to see your faces and continue, right? Okay, so this is a present value. Now you know what is present value and how do we link a present value with the future value. So that is the interest rate we have learned here. In a simple present value, right, you might have, right, kind of different ideas as well, right, or like sequence of cash flows. Earlier I saw, okay, after 1 year you get $100, or after 2 years you will get $120, so something like that. Sometime, right, the cash flow may be a little bit different, right? So that maybe you will be getting a continuous equal cash flow. So how do we calculate a simple present value, right? As I said earlier, we can see, right, if we want to see, right, present value or a future value, right, you can take this $100 and within bracket 1 plus 10% interest rate, you will get 110, right? It's a one-off payment we are talking about here. But here you are going to discuss a kind of sequence of cash flows, like, so here you might be knowing, I'm just quickly going through. If you have any difficulties, just let me know, right? So the problem is you cannot compare directly, right? Okay, so today you are getting 100. Can you compare that one, a cash flow like you will be getting, as I said, in the lottery, like $1 million today, or okay, or 1.2 million within 6 years time, right? So you may be face of it, you could think, okay, this is 1 million and you are going to get 1.2 million, or 1.2 million is higher than 1 million, so that might be better. But that is not the case, because we are going to get it over a period of time. So you have to make it that also as a present value, and then you can compare, right? Here, if somebody says, okay, every year you are going to get 100 rupees or $100. So what is your present value? So present value, okay, today's, if you are going to get, that is $100 is $100 today's value. But every year thereafter, when you get $100, so you have to discount, right? So that's what here, like cash flows, future cash flows every 1 year or second year, and nth year you have the cash flows. So you have to discount all these cash flows and add together and see present value. Then only you can compare. Okay, so then simple present, you would be able to calculate for a single transactions or maybe or multiple payments. So based on the durations or period of payment, you would be able to calculate the present value and compare. So always keep in mind here, okay, time, the time of payment is matter, right? When the time goes on and on, your value become less and less, right? So 100 rupee or payment today is better than tomorrow, or tomorrow is better than day after tomorrow, right? So when the period is longer and longer, your value is less and less. Got my point? So then for that formula, the present value may be equal to cash flow divided by 1 plus I power to n, right? So here two different cash flows I have measured, like I have explained. One is a single cash flow, other one is sequence of cash flow. I hope you understand. Still, I want to confirm from Rajakarna, are you still there? Oh, Vidura, is that okay?
Yes, sir.
All right. Sure. Right. So next one, yield to maturity. Right. Now you know what is interest rate, right? That links your present value to the future, right? The present values to the future may be a single payment or maybe a sequence of payment. Whatever the ways, you get your interest rate, right? Okay. The next question is, the interest rate is of course okay, right? But how much your yield? Why I'm saying like that? Because yield always change in line with the maturity, right? The interest rate that equates the present value of cash flow payments received from a debt instrument with its value date, right? You take the value date and then you take the present value of all the future cash flows and then you equate with interest rate, then you will get a yield to maturity, right? If you understand, if you don't understand, let's see through these four important credit market instruments, right? If you are a banker, you would be able to understand or tell me, right? You have different kinds of products, lending products. That can be a simple loan product, or that can be a fixed payment loan product, or maybe you may be selling coupon bonds, or you may be selling discounted bond or buying, right? So where we are going to always think about yield to maturity, right? So let's see how that works. Now, if you take a yield to maturity on a simple loan, right? Let's assume, right? I'm going to give you 100 bucks to you. After 1 year, right? You are going to give me 110 bucks, right? It's a simple loan. I'm giving 100 bucks today, and after 1 year, you're going to give me 110 bucks. So what is the yield to maturity for me, right? It's similar to the previous present value, right? What is the present value? 100 bucks. How much you are going to give after 1 year? 110 bucks. How many years? That's only 1 year, right? So as I said, you put in this formula, present value is equal present value, future value divided by 1 plus I to the power n, right? 1 plus I, right? We don't know. We don't know. The power is 1 because it's 1 year, right? And then if you simplify this formula, you will get I is equal 0.1%. That means 10%. So your yield to maturity is 10%, right? But it seems to be for you no difference between yield to maturity and interest rate. But the problem here is, in this instance, yes, of course, the simple loans perspective, the interest rate equals the yield to maturity, right? But not all other cases, right? Here we are very clear within that, because your loan matured in 1 year's time. After 1 year, you are getting this money back. So then interest rate equals to yield to maturity. That's clear. But if something changed in the sense, okay, even though the maturity is 1 year, you are going to get back your money after 6 months. Then of course the problem comes. In a plain vanilla situation, if it's a simple loan, okay, the interest rate equals the yield to maturity. Is that okay? Now you can think of an import loan, right? You are giving a customer import loan, right? Maybe 100 bucks, right? And saying for 10%. End of 1 year, that may be import loan, maybe for 1 year's time. So end of 1 year, he is going to be giving 100 $10. So what is your interest rate? 10%. And what is your yield also? It's a 10%. Right? It's a simple loan in your related to in your banking product, something like that. Is it clear?
Yes, sir.
Thank you. So then, when it comes to fixed payment loan, this is the one you usually use it. Maybe term loans, maybe personal loans, maybe housing loans. So whatever it happens, right? So whatever the issue is there, but the pattern might be same, right? In the sense, the fixed payment loan, you are giving a housing loan, right? That is the loan value. But every month, or for simplicity, I'm taking for annual payment repayment. So you'll be getting fixed payments from the customer. So every time when you discount, okay, anyway, like, so you have to discount. Now you are clear on the discounting, right? So any cash flow, if you discount with that interest rate, you will get into present value, right? So the FV means, LV means loan value, FP means fixed yearly payment, and then N number of years until maturity, right? So here, every time, this is the first year and second year and third year, and then continuously for nth year. So if you can discount all these present, the future value payments, you will get a loan value. Right? So then in a fixed payment loan, you have to think about, okay, how we are going to convert these future payments into present value. That's your loan value, right? Now, anybody working here in a bank or like in a credit sections or finance sections, or maybe treasury? Who's that? No, I didn't get any message. So, okay. Can anybody tell me, based on this example, or can I can go with Rangana? So now we always talk about this impairment, right? How that works?
Can you repeat, sir? I didn't get.
Yeah, now, okay. If are you working at a bank, Rangana?
Yeah.
Okay. So now, based on this concept, can you explain to me, how do we see impairment under this concept? How do you work? Okay, the impairment, how does it work? You know impairment, right? Are you working in credit sections or finance?
Yes.
Okay. Can you give me a little bit essence of impairment? Based on this formula, now what I have said is, okay, you have to discount all these future payments, then you will get a loan value. What is mean by impairment? Anybody or Rangan or anybody else? What is mean by impairment?
The probable loss.
Okay, probable loss. Anybody else? Okay, take it as a staff loan, or take a staff loan that has been given to you, right? Okay, now you got the staff loan, maybe 1 million loan. You will be paying future payment and settle that loan. Is there, would you see any impairment? on that kind of loan, staff loan. When you say probable loss, what is the cause of that loss? Why you are saying probable loss? Why it's coming in?
We are missing the interest payment which to be received in future. So if the staff settle it prematurely, we are losing some interest there, which could have been received. That is the loss.
Okay, can you say always that is a loss? Because like we study here, okay, the getting payment today is better than always getting payment in future, right? That is our concept. So if somebody is going to settle early, it does not necessarily mean that there's a loss, right? Because like sometimes you may be charging for some other reasons, early settlement fee and all, right? But still, it doesn't mean like, okay, you're going to lose. You are talking about early settlement, right? Not the default, right? When you lose interest, but same time you are getting the money early. Anybody else? Gavin, you are here today? Yes. Go ahead. What do you mean by impairment, Gavin? So if you can give me some example.
Good afternoon, sir. Sorry, I joined in a little late.
Okay, that's okay. I know. Just asking, what about, do you know about impairment?
Sorry?
Impairment?
Impairment? Not really. I don't have a clear idea about it.
No issue. Okay, so there are few hints, but not very close, in the sense like when we say impairment, that's, as you said, possible losses, or like a losing value in your financial assets, right? Loan is a financial assets, right? You may be losing your value, in the sense loan value today is 10,000, right? So then if you lose that value, maybe if you measure it today, that may be 9,000, not 10,000. So you're losing your 1,000 rupees out of your loan, right? Now, when you calculate this loan value from future payments, now you can see this FB every year we are discounting, right? Okay, let's assume this is interest rate is 10%, right? So when you discount, okay, maybe this every year, make it annual payment. Every year you are paying 1,100 or something like that, and then when you calculate by 10%, you get a loan value is 10,000. So whatever you have given to your customer, maybe 10,000, that is 10,000. So when you calculate this future value, discounted future value also equal to the 10,000. So your kind of loan value is unchanged. Is that okay? You got it what I'm saying?
Yes, sir.
Yes, thanks. So again, I repeat it. I give you a loan today, 10,000, and you have a payment schedule, annual payment schedule. Okay, maybe 1,100 for 10 years. If we discount all these future payments by 10%, right? Each and every future payments by 10%, then that becomes as 10,000. Assume like that, because I don't have anything to draw and calculation show it. But now whatever you have lent to the customer and the present value of the future payments, both are equal. That means your loan value and your present value of future payments are equal. You didn't lose it. There's no impairment. There's no loss of value in your loan portfolio. Right? Now what I'm asking is, okay, in the case of, take it as a staff loan. I don't want to bring it other factors into this, right? So if you have some kind of accounting understanding, when the interest rate changes in the market, right? Now you are going to discount this loan, the future payments, by the new rate. Let's assume now it's 15%. Now you are going to discount these future payments by 15% interest rate. Now, can anybody tell me, when you make these future payments into present value using new rate, what would be the value? Is it more than 10,000, or is it still equal 10,000, or below 10,000?
Below 10,000?
Exactly, below 10,000. So where, like, if you see after calculation, if it is 8,000, you have an impairment of 2,000, because now your loan value is, even though you lent 10,000, you are getting the same future payments from the customer, but your present value of the future payment is 8,000. You are going to lose 2,000. That is impairment. Right? So now the question is, okay, how this simple loan works, how this fixed payment loan works, you should be able to understand. Right? So even though we say interest rate, right, so that will have the different impact on linking three aspects. We have seen what are those three aspects. One is linking with future value with the present value. Other one is reward on lending. Other one is cost of borrowing. So here what we are saying is how that, you know, manipulate the value of the loan when the interest rate changes, or when the value of the loan changes, how that interest rate may be calculated. Is that clear? I hope it's clear. If you are not clear, if you have any doubts, you can ask. Normally I just want to try to explain this item with your, you know, banking production experience, so that might be helpful for you. So if it is okay, we can move on to next.
Excuse me, sir. I have a small doubt.
Yeah.
In the previous example that we discussed, we came to a conclusion that there is a loss or impairment of 2,000. So
Yes.
that impairment comes only if we do not charge an interest rate as it is in the market, right? If, let's say, if we are charging 10% on that staff loan, all of a sudden the market rate goes up, so we are discounting the future payments at 15%, then only the loss comes, no, sir? If we
Exactly.
charge the 15%, there won't be any loss, no, sir?
Yeah. In the sense, like, there won't be any loss. Normally in the accounting, but that's what I always, I go with the practical. Your concept is correct. No question on that. I go with the practical scenarios where staff loans rates are normally
Yes,
less.
that's the thing. Yes.
So then when it comes to accounting treatment, we should have this kind of adjustment. Or that loss should be borne by the bank.
So this applies for the loans of which are under fixed rates, is it?
It doesn't necessarily means for fixed rate. If it is fixed, of course, yes. But even though if it is floating, it's the time when you are calculating this one. Even though, like, if you say annually you are charging, or if it is floating and you can reprice it annually, then within that even you can have a different rates, right? Market rate maybe differs from the actual rate, right? So still flexible, of course, like, you can reduce the loss, but doesn't mean you can necessarily wipe off everything. And I just also want to add your question because it's a valid question. Normally, we don't have these banks. We don't have that kind of very good system to, cater immediately for any changes. So the banks, what they do is like, okay, as you said, okay, within 1 year, if there's any changes, if they don't take into account saying like it's not a material, and after 1 year, like as of repricing date, it would be repriced. So then there won't be any loss kind of stories they bring it. It's based on the inability of the system to capture those. But realistically or theoretically, when we speak, yes, of course, some elements are there where that also for in a floating rate that also will have some kind of impairment unless you do it as of that day. You got my point? Or is it clear? No or yes?
Yes, sir. For us, it's clear. Yeah.
All right. Thank you. Thank you.
Yes.
Anybody wants to ask any question? Okay. Next one, the third item. So we have seen a simple law. It's a single payment, or like fixed payment. It's a sequence of payments. Or third one, it's a coupon bond as an example, right? It's also kind of similar strategy, but the problem is as a fixed payment loan, but end of the tenure, you also get your investment back or face value back. Take as a treasury bill as an example, right? Now, today you are going to, right? Hold on for a while. Yeah, sorry. So we are talking about the coupon bond. So treasury bond, take it as, treasury bond as an example, right? Okay, treasury bond, you can buy it. So your bank can buy it. So they can use it for so many purpose. But major one is, what is the major one? Why these banks are buying treasury bills and bonds? Why banks are investing on treasury bills or bonds? That Dilshani? Maybe your mic is mute. Or Dilushi? Are you all there? Or
Sir, I'm not sure, but is it because banks need to have like some kind of government securities to lend from the central bank?
Not really.
As per what do you call regulatory requirement?
I didn't think so. Yeah, there are regulations, but doesn't mean you should invest on treasury bills and bonds. A kind of mandatory requirement. I'm doubt on that. Yes.
So what do you call that? Zero risk. What do you call it? There's no default risk in these securities. So it's a what do you call secured investment where we can invest. So I think it's a secured investment.
Yeah, your point is valid, but still, why? So because the banking business is anyway risk taking. So they should be able to, anyway compare risk and return always. You can't eliminate risk in a banking business because always you are going to lend money. My question is, okay, you're going to lend money. If you are going to lend to a kind of a housing loan, you can earn more than an investment on treasury bills. You can give term loans, you can give lease, but still why banks are going into invest on treasury bills and bonds? The the major perspective of that investment, not like there may be several factors, as you said, one of the factors zero default risk, yes, of course, but beyond that, why we want to have that?
To ensure a guaranteed return.
Ensure guaranteed return, yes, of course you are getting return, but what I'm saying is you have other avenue to get more return. Why you are going to start with this one? And
in order to meet the reserve requirement.
Which requirement, Rajakarna?
In order to meet the reserve requirement, in order to maintain that ratios, the central bank requirements.
What is the reserve requirement? What do you mean by reserve requirement? If you can elaborate on that further.
Is any necessary to invest? I mean, that is the maintain the banking portfolios and especially the deposits. So you need to maintain the reserve requirement according to the central bank guidelines. So that is a very trust and secured investment for their, I mean, in order to meet this reserve requirement. I mean, investing for the treasury bills and bonds.
Oh yeah, I got your point in the sense, okay, your point is valid. Okay, banks are deposit taking institutions. Then wherever a liability fall in due, as and when due, the bank should be able to pay back. So take a deposits, bank should be able to pay back as and when due. Now, I think we have discussed already this maturity transformation in a financial system analysis. What do you mean by that? So the banks getting small deposits or smaller tenor deposits, maybe 1 year, 2 year deposits or 5 years maximum deposits. But then they lend it to for 20 years loan, housing loan, maybe 20 years. So it's kind of maturity transformation. You transfer small tenor into larger tenor. Maturity transformation is one of the business of these banks. But the question is, now somebody, if the deposit holders come and ask you to return the deposits, how we are going to get the money? Can you get it from the loans immediately? Can you ask the customers to pay back immediately? No, it's not going to happen. So you should have some kind of cushion that is called not the reserve, that is the liquid assets. You should maintain liquid assets, right, to pay back those deposit liabilities as and when due. The problem is, if you have a liquid assets, in the sense cash is a liquid assets, the 100% liquid asset we have studied. Can this bank keep their assets as cash? Anybody? Do they want to, like, will they do it?
Cash will not give banks any return. So
Exactly.
like a zero return asset.
Exactly. So then banks, maybe for day-to-day activities, they can have a minimum level of cash, but same time they should have some assets that could be convertible as and when necessary with the minimum loss or no loss. Right? That's a liquidity definition. So if you take a treasury bill, right, they can go for sale, outright sale, or kind of repo borrowings. They can repo it and borrow it immediately. So same time, they also earning a return, reasonable return. So that's what banks are willing to invest on treasury bills and bonds, because the central bank liquidity requirement says there's a statutory liquid assets ratio, SRR, sorry, statutory SLAR, right? Statutory liquid assets ratio, it says they have to maintain 20% of liquid assets, 20% liquid assets of their liabilities, excluding some of the liabilities, maybe example capital, right? So that's what these banks are going to invest on treasury bills and bonds, because that also considered as liquid assets, right? There are so many items. The major item is treasury bills and bonds. Got it? So now this liquidity and the returns are working in opposite directions. If assets is highly liquid, you will get very lower return. If asset is illiquid, so you could get a better returns. That's what the trade-off comes. Banks should decide how much you are going to keep it. But that's what always banks are, trying to have minimum liquidity, because they don't earn much. That's what the central bank knows that, because unless there is regulations, these people won't have liquid assets, because like that is costly for them. That's what central bank says. Okay, you should have minimum liquid assets based on these calculations, SLAR, right? So then banks go and invest on treasury bills and bonds, right? So in this scenario, now you can got it right. Any question on that?
See, what is the latest SLAR?
When it comes to latest SLAR, still 20%, but only thing is during this COVID, the central bank has allowed the banks to take some more items as liquid assets. Earlier, it's a definite liquid assets, cash, treasury bills, treasury bonds, balances with banks or central banks, something like that and all. Now, in addition to that, some guarantees and all, they can take it, right? For that also, I think going to be over. Oh, I think might be over. You can see this in the central bank website. So during this COVID, because of the, the backup given to the banks, one of the item under this, we didn't change any ratio or rate, but we changed the item that should be included. We have given additional item also to be included. That's what they manage this liquidity ratio, because these are statutory ratios. You can't suddenly change those. Is that okay?
Yes, sir.
Okay, thank you. And if there's no question, so I can come back to this. So the banks, they invest on this coupon bonds, that means treasury bonds. Let's assume 100 rupee worth of treasury bonds. You buy it from the market at 100 rupees. How often we get a coupon for a treasury bond? Anybody? If you are going to invest on a treasury bond, yes. Just a minute.
Less than 1 year?
What do you mean by that? When you say coupon, so they indirectly they will be paying interest for you. My question is how often they will be paying that interest?
2 times a year?
Twice.
Biannual.
Maturity.
Yes.
6 months.
Yes, all are correct. Biannual, 6 months, twice a year. Yes, it's every 6 months you will be getting the coupon interest, right? So you will be getting every 6 months income out of investment. But here, for easy examples, I here's a book example anyway. It's an annual coupon, yeah, yearly coupon payment. And then when it comes to F means a face value of the bond. That means if you go to a bond paper, it's the amount fixed there. That is your face value, right? Anybody wants to ask any question? Okay, so that's a face value. And years to maturity date, maybe that may be a 3-year bond or 2-year bond. That's a bond maturity, right? Or period, tenor. So if you see this formula, I just explained, the P is the price of the coupon bond. That means if you buy a coupon bond at 100 rupees, paying 100 rupees, the 100 is your price of your bond. Now every biannually in real world, but this is annual coupon. So every year you will be getting coupon. First year, yes, this one. And second year, you have to discount it by 2. And third year, you have to discount by 3. And n year, you have to discount it by n. Right? So now, these coupons all together, this is the present value of coupon. At the end of maturity, not only you get the coupon, but also you will get face value of that. Now you invested on 100 rupee bond you have given. So then the face value is 100 rupee. So that also would be returned to you. So if you discount, these are two cash flows. One is coupon, other one is second one is your face value. If you get this, if you discounted these cash flows, right? So you will get a price of the coupon bond. Is that clear? Okay, let's go ahead and see. If you don't get it clearly, you can ask me at any time. Okay, now here in this picture, this is the US coupon, right? So United States of America coupon, right? In the coupon, you could see 4 items. One is face value, right? This is 5,000 bucks coupon face value. And agencies that issued this bond, okay, United States of America, that's a government bond. And then maturity date, you could see, if you can enlarge this one, I think somewhere August, I couldn't see anyway. Let's see. Yeah, now you can see 88% treasury note series. This is right, dated August 1676, due August 1586, right? And the coupon maturity date is August 1586, and the coupon rate is 8%, right? Now you could see these are the coupons. I don't know, you can remember those days when we were too small, that families now, like Samurti families, those days also like kind of families who were under poverty, they used to get this coupon and they can submit this coupon in cooperative society shops and get the stuff. Anybody could remember? Right, it's a similar story. Here also you could see, right? Okay, coupons. If you can see, this is February 1586, and this is August 1586, this is February 1585, and August 1585, like that. Every time you will get 200 bucks, right? Is that okay? Come on, guys. Is that okay? Yeah. Okay, so now you know this is the bond. So these are the very important things under a bond. Only question is, now if I go back to this slide, here I always say you pay the money, that means the price of the coupon bond is equal to the face value. If it is 5,000, when you are buying, you are going to pay 5,000, right? That is the assumption I am taking here, right? So then when you purchase, that is the normal cost of business. If it is a 5,000 bond, you are going to pay 5,000. If central bank is issuing at a bond at a primary market, so banks are going to buy that the face value, right? Okay, is that clear?
Yes, sir. It's all clear.
Okay, thank you. So then the concept behind this is, I'll go back to this one. I said the price at what you bought this bond is equal to face value. Then your interest rate, that means the coupon rate is the interest rate, that is equal to your yield, right? Make it clear. This coupon rate is equal to yield rate, right? There's no issue. That's what I have mentioned here. The coupon bond is priced at face value. The yield to maturity equals the coupon rate. Make it clear, because here we are talking about the annual coupon, right? Not half yearly coupon. This is annual coupon for simplicity. If that is the annual coupon rate, and if you buy a bond at a price that is equal to the face value, then your coupon rate and the yield to maturity rates are equal rates, right? So that is proved here. This first formula, you know this one, I explained the first slide, right? So it's a, when you simplify this one, you will get this formula. You can work out and see, right? I don't want to go into that details because that is the high school calculation. So I don't want to unnecessary calculation I don't want to bring in. Finally, if your price and the face value are equal, then your yield rate is equal to your coupon rate. Right? Don't worry about the calculation. You can, if you don't understand, okay, in the sense you can ask in the coming classes, but I don't want to go into that details, and you don't get, in my area, you don't get any questions like to, see these formulas and all. So nothing to worry about the exams due to this factor. Okay. So keep in mind, right? So if face value and the price of the bond are same, then your coupon rate and the yield to maturity rates are equal. From these slides, I will show you, right? Now you can see this one. The price of a coupon bond and the yield to maturity are negatively related. I will explain, right? The yield to maturity is greater than the coupon rate when the bond price is below its face value, right? Okay, now you assume you are buying a bond, right? The bond face value is $1,000, right? See the table one, this one. 10% coupon rate bond. Coupon rate how much? 10%. Maturing in 10 years. It's a 10-year tenor coupon bond. And face value is 10,000. Now the problem is, if you buy that coupon bond at a price of 1,000, right? Here, if you take the table, what is the price of, what is the face value of this coupon bond? Come on, we have to talk. What is the face value of the coupon bond?
$1,000.
$1,000. Very good. What is the coupon rate? That means interest rate income we are going to receive. Coupon rate is
10%.
10%. Good. Now you are going to buy that bond at a price which is equal to face value. That means $1,000. If you buy that coupon bond at 1,000 rupees, which is the face value, then your coupon rate is equal to the yield to maturity. Right? You can see, because you are not going to earn more or earn less, because you are paying the money which is equal to the face value. Nobody give you discount, nobody give you at a premium. You are going to buy at a face value. So then your coupon rate is equal to yield to maturity. Let's assume, even though the face value of this bond is 1,000, but you are going to buy this bond at 1,100. Now you are giving more money than face value. So if you go back to this formula, now this one, right, face value is 1,000, but here you are paying 1,100. That means you pay more. So your yield, what happened to your yield now? You will earn more than your coupon rate, or equal to the coupon rate, or less than your coupon rate. If you pay more, your yield might be what?
Less.
Less. Very good. So if you buy 1,100, you can see here. So your yield would be 8.48%. If you buy this bond at 1,200, your yield to maturity would be 7.13. So when you give more price to the bond, then your yield would be, that means your profit kind of idea keep in your mind will be lesser. So that's what the very first sentence says. The price of a coupon bond, right, this one, and the yield to maturity are negatively related. When the price goes up, your yield is less. But the other way around, if you buy this coupon bond at 900 rupees, then you are giving lesser than the face value. So you are getting at a discount. Then what will happen? Your yield to maturity will go up. Even though the coupon rate is 10%, every time you will be getting the 10% of the 1,000 is 100 rupees. Every annual you will be getting coupon of 100. But now your yield rate is 11.75% because you made a profit of additional 100 here because you bought this coupon bond at a discount. So now when the values are going down, your yield will be going up. So negatively related. That's what the second sentence says. The yield to maturity is greater than the coupon rate when the bond price is below its face value. Now you can see 900, 800. When the price is below the face value, your yield will be more than your coupon rate. Is that okay? Is that clear? So whenever your bank buys, right? So if you are a treasury, working at a treasury front office, then you would be thinking whenever you quote prices, right? Or you would be thinking, okay, what is your bank's intent on the yield to maturity? What is your expectation? You don't look at the coupon rate. You will look at the yield to maturity and see at what price you can buy this one from the market, right? Now it's interest changing rapidly, interest increasing, right? In the market, you could see interest increasing. Now, what is the latest rate? Anybody? Latest auction, roughly, in the treasury bill auctions, 364 days treasury bills auction. Visista. Now it's, you could see in the market, treasury bill rates are like, increasing at a speedy rate. That's also one of the issue banks are facing now currently. But nobody knows how long would it continue, but it's a kind of speed increase. So anybody? Okay, no issue. Just I just want to see whether you are in line with the market changes. Of course, now it's a 7 point somewhere average one, right? So increasing, but still banks are having 5%, 4% deposit rates. Now people will be switching from deposits to treasury bills and bonds, right? So banks should reprice it as soon as possible. Otherwise, like, depositors may be losing. So here, when the market rate changes like that, what will happen to the bond price? Anybody? Anyway, when the treasury bills, bond prices increases, definitely it's going to increase. So what will happen to the bond you have now? The price
Price will go down.
Price will go down, right? When the rates increase. Now you could see, if you are a finance department, if you are in a trading desk, so you can have this treasury bills bond in your trading book. If it is a trading book instruments, what is the major requirement of that? Anybody? Anybody understand what I'm talking about, the trading book? Now you buy a bond, treasury bill or bond, and then there's a question whether you are going to keep that bond until maturity or whether you are going to sell it at any time. Simple example I'm giving. I'm not going into detail technical aspect. A simple example. So if you are going to keep that until maturity, you have no issue. You can keep it as a banking book, right? But if you are going to sell at any time, that is your intention, then you have to keep that in the trading book. If you are going to keep that bond in a trading book, what you should do? That's a question. And rather, what can you do? What you should do based on the accounting standard or maybe regulations? You got the question, right? What I'm asking? At least yes or no. Are you there? Or okay, I couldn't hear from you. Next in list, Chaminder, what do you think?
Can't hear this question.
Okay, Chaminder, what I'm asking is now, okay, now it's interest increasing scenario in Sri Lanka. Okay.
Yes.
Now your bank bought treasury bond, right? Now that treasury bond is kept under trading book. If any financial assets are kept under trading book, you should do always a very important thing. What is that? If you are in that field, you can easily understand my questions. If you are not in that sections, maybe a little bit confusion. Okay. Chaturanga.
We have to always keep a track on the interest rate movements.
Okay.
And if the rate is going up, I think our price of bills will go down. So the better to keep it till the maturity.
Okay. Yes. Yes, some extent your suggestions, but if I am a CEO, I don't agree with you, right? If I am a CEO of your bank, but some extent your answer is correct, but still, okay. So anybody else? But I didn't get to the point. So
You have to
anybody?
reprice it.
Sorry.
You have to reprice it.
Oh, Rangana. So that's when you say reprice it, what is that?
I mean, to roll over, like to sell the existing ones and go for new ones.
Okay, sell that existing one. Okay, now at what price we can sell the existing one? It's an all price or new price? That means we know when the interest rate goes up, your value will come down. So if you are going to sell that, you are going to sell at your previous price or maybe new price. That means less value price. Okay. So when you say like that, I didn't see any impact, because anyway, if you are going to sell it, you are going to sell it at a lower price, then you are going to lose it anyway. So buying a new bond, it's not going to make any sense through that. Yeah, Dilshani.
So you mark the bonds to the market? You mark to market it?
Exactly. This is what I wanted, and technical word as well. So when you have, very good, Dilshani. So when you have your treasury bills or bonds under trading book, that means anytime you would be able to sell. Unless, you keep it in mind, so unless if you don't keep this trading bill, treasury bills and bonds under trading book, or if you keep those under banking book, you cannot sell those without proper documentation intention. There are so many regulations on that. That's what these banks always classified most of the trading treasury bills and bonds under trading book, because this is why you are keeping, to mitigate your liquidity risk. So anytime you should be able to sell those. So then definitely you should have these treasury bills and bonds under trading book. If you are keeping under trading book, that means your intention is to sell at any time. Then that book, that means the treasury bills and bond, should reflect your market price, the current market price. Can you keep this trading book? Okay, the market price is 100 rupees, but can you keep saying your treasury bill is worth of 1,000 rupees? No, because that is then not fair, because when you are going to sell it, you are going to get only 100 rupees. So that's what, as Dilshani said, we have to always mark to market this trading book. So now if you keep this 1,000, value of $1,000 of this treasury bonds under trading book, you have to do mark to market. and keep it. Now, when the rate changes, your price will change. Now, every bank will be booking a losses, mark-to-market losses into their books if they keep in those treasury bills and bonds under trading book. So now you should be able to understand whenever you decide to invest in treasury bills and bonds, you have to always keep in mind your yield to maturity, not the coupon rate. What is the yield to maturity? At what price if you buy, you can maintain this yield to maturity, right? So the coupon rate and yield to maturity, these are very important concept in valuing financial instruments, right? Is that clear? Any question on that?
So when there is such a situation where the interest rate goes up, so mark to market will definitely make a loss to the bank. No, sir?
Exactly.
So, okay. So is there any way we can remove it from the trading book and keep it in some other place? I don't know, because
I got your yes, I got your concern. Now the problem is, as a regulator, I'm just telling central bank point of view. Now, if you can mitigate like that, is it prudent? Well, like, okay, when the interest rate is coming down, you can keep it in the trading book and adjust the value. So value is increasing. Then the price, like interest rate is going up, you just change from trading book to banking book and you just keep quiet. Is it prudent practice? Can we allow like that? Chaturanga, can we allow like that?
I'm not very clear on that area, so that's why I asked.
No, I'm just asking. This is a discussion. Nothing wrong or right into discussing this. This what I want actually. Yes. So you are thinking from bankers' point of view. I'm thinking from regulators' point of view, right? And safeguarding depositors' interest. That's what we have to, different kinds of conflict of interest. We may call it. But the thing is, your question is very good. The banker's point of view, that's the question we always have. That's what we don't encourage that one. You can't do that. Whenever you have the loss, you have to book it, right? So then you take as an impairment, or you take as a additional provision or mark-to-market losses. We always want to bank to have an additional cushion, right? So you can't do that. The regulation, there are strict regulations. Once you decide this is a trading, that's it. You cannot switch unless there's a serious, there are some examples. If there are serious, not on that, of course, you can request regulators, but of course, no way. Or like even some banks, they just put in the banking book and keep quiet, because like you don't need to sell it, but you can use it for repo borrowing. You got my point, Chaturanga?
Yes, I got it. Yes.
Yeah, without keeping a trading book, some banks can do like they can keep into banking book, and if they want to any liquid, facilities, they need to sell those outright. They can just go for repo, so then they can get the money. And other way around as well. If you keep it in a trading book, when the interest rate going down scenario, you will be getting gain as well. You did for several years. Now suddenly you are in other way around, right? So that's what you should have always a proper risk management system in the bank to mitigate those. Okay, so this is the coupon bond scenario, right? And the coupon bond scenario, actually, this is not in Sri Lanka as far as I know, and worldwide also it's no more now. We call it console or perpetuity, right? According to this textbooks, even it was issued in 1751, and those stories were there. I just mentioned for you all, like why I'm just incorporating this one, even though we don't have this market. You should know what's happening in the US market always, and how do we talk, what are the instruments they have, and how do they analyze, because that is the sophisticated market in this world, right? So most of the economies follows their model, right? Most of the researchers, the findings are coming from their market. So that's what I just picked those um, items, because when you talk, when you discuss, when you do presentation, you should be able to show that, okay, I know US market as well, right? That's one kind of marketing tools, right? Here I have mentioned that as well, this coupon bond under, right, console, we call it console, right, or perpetuity. So here when it comes to console means there's no maturity, right? It's lifelong, you invest, and lifelong you will be having payments, coupon payments, right? If you want to calculate, I just simply say that. So if you want to see the price of that console, that is just to take the coupon divide by, right, the price of the console, you have to divide by your interest or yield to maturity. Take the coupon and divide by the yield to maturity, you will get the price. Or if you want to get the yield to maturity, you take the coupon and divide by price. So it's other way around. So here I have clearly given these items. I don't think it's very difficult to understand, but you can replicate this one with our shares, right? Now let's tell me, how do we do valuation? Okay, a house. Okay, we are going to value an assets. How do we value an asset? That can be a financial instruments, or that can be a real assets, whatever the assets. If you are going to value that assets, what you're going to do? Anybody? Anuradha?
Basically, we call a valuation report from a professional. I mean, that is property or noble property. We principal methods, so investment methods for household property, commercial property.
Okay. Brother, okay. If you are going to value, okay, you got the valuation from panel of valuers. That's fine. If you are going to value, how you are going to value? Take an okay house. How you are going to value that?
In the sense of market value or the for sale value, that the minimum value we can sell the next buy in the future.
Next buyer.
I mean, in the secondary market, how the for sale value normally we concern for the banking aspects, because the minimum value we can sell it to the next buyer.
Okay, I got it. I got it. Okay, now we have two kinds of values in the valuation report. One is, market value. Other one is for sale value. I agreed with Anuradha, but I still have a doubt. How do we arrive that value? I don't call it market value or like, okay, for sale value. If you want to, arrive into a value, okay. Thank you, Anuradha. And next I can go with Dilushi. How do you value any assets? Okay. Visista, I didn't hear from few, just to have a chat.
Yeah.
Yes, how do you value? Any idea? Okay, no issue. Vidura? Anybody else? Final call.
We always try to look at the value of a similar kind of asset, and based on that we arrive at a value. The
Okay,
market.
okay. Right. Always we want to look at this the market price of a similar kind of assets, right? So that is your valuation. But that is also correct. I don't deny that, right? As Anuradha said and you said, okay. But the basic concept is when it comes to valuation, right? So okay, let's assume like, okay, you're going to, okay, I don't know whether it's appropriate example. Okay, you are going to buy a person. How do you value him? Okay, that may be toughest questions compared to financial assets or real assets. Okay, come to the point. Now, when you value, you're going to value based on the future usage, right? What is, if you take a machinery, okay, what will be the future usage? If you are going to talk about house, what will be the future usage? How do we going to quantify the usages? Rental value. If you take a house, you can see the valuation report. Now hereafter you go and see your valuation reports. They will calculate all these rentals they put together. Okay, this area, this is the rental, so annually you can earn this much. Okay, so lifelong, okay, this much you can earn, so it's a discounted price. So then you will say, okay, this is 20 million worth of house, because that house can generate for the period of 20 or 30 years lifelong a rental. It's a sequence of payments you will get. Based on that, you take this like that earlier, like simple loan, right? We not simple loan, like, okay, fixed payment loan. You take, put it all these payments and discount and see, okay, this is the value. Even loan is same, house is same, any of the financial instruments is same. Why I'm explaining it now is, if you go and invest on a share, you want to buy shares in the share market. So one of the major assessment, okay, whether this price is correct, how do you value it? There are so many valuation methods, but one of the key valuation method is what? Anybody? Is there any maturity for these shares? If
no.
you're no
Investment method, sir?
Sorry,
investment method.
what do you mean by that? I'm just exactly asking, like, how do you calculate? So if you can go into that details and say, so everybody can understand. Okay, now when you invest on a shares, you are sure like there's no maturity. It's a infinitive lifetime. That's what our assumption. It's a perpetuity. How do we value then the price, right? we are going to take all these are like dividend. We assume, okay, they will be paying annually. Maybe this is the dividend, lifelong, right? So if you take this lifelong dividend, that is here, see, I have said coupon, where you have to put dividend. And then if you put your yield to maturity, you will get a price, right? It's a console, the US console, similar to this calculation of a dividend, a company, right? Or share. If you want to calculate the value of the company, this is the way how much this company can earn in the future. That is infinitive. So take that dividend and divide it by your yield to maturity. I'm just giving these thoughts. Am I confusing you all, or you are just got it clearly? Gavin, that's okay? Clear?
So can you just repeat it again?
Yeah. Now, what I want to say is that the coupon bond, so again, coming into coupon bond, some bonds have no maturity. So it's a lifelong. It will be going every year you will be getting coupon, right? So then if you don't have the maturity, how do you value that? How do we price that? That's a question. So here I apply this one to similar to shares as well. If you are going to invest in a shares, right? Let's assume John kills shares. You are not going to sell it again. So, every annual you will be expectation, or maybe Sampath Bank shares, like maybe 18 rupees per annum they may be paying. Now you have to think at what price I can buy these shares. Right? This is little bit different than earlier we discussed, because here there's no maturity. If there's no maturity, your price, the market price, would be arrived by taking this dividend or coupon rate divided by yield to maturity or interest rate. It's actually yield to maturity. For simplicity, I'm saying interest rate. So when you compare the previous calculations, every calculation is different. Here, when it comes to console or shares, this is no maturity, then yield to maturity is different calculations. So here what I want to say is you should have two things in your mind. One, as I explained, everything based on the future usage. That means future cash flows. Any valuation based on the future cash flows. That's one concept you should understand. That's the basic for everything. And second, if there's a financial assets that has no maturity, then how to value that. That's what I have given here. That is called in US market, the coupon bond, that's called console. Here we don't have this console. You can think of an shares, entity shares. Nothing to confuse. Just keep as we discussed earlier, right? I'm going back again to make it clear, right? Yield to maturity, we are discussing under 4 types of loans. One is simple loan, other one is fixed payment loan, other one is coupon bond, we have discussed. Only thing is the simple, fixed and coupon bond, they have maturity, but there's another coupon bond that has no maturity, that is called console. That is different calculation. That's what I wanted to show you. That also I show you, right? Just think of these again, and if there's any issue, even you can ask in the next class. But if you have any doubts, still you can ask, right? Is that okay?
Yes, it's all right. Thank you.
All right, thanks. If the one more thing, like if you don't, maybe attend this kind of calculation in your high school or like maybe bachelor degrees, I am pretty sure like most of the people might have done this one. If you haven't, so then go through again and see if there's any issue. Even you can ask me, right? Okay, now the next category, discount bond. When it comes to discount bond, what you can think of? Which instrument you can think of? Anybody? Which instrument you can think of?
Treasury bills?
Exactly, yeah. So treasury bills. Now, when somebody says about coupon, you should be able to know, okay, he's talking about treasury bond. When somebody is talking about discount bond, you should be able to think of treasury bonds, because treasury bond issuance is something different. The government of Sri Lanka will issue treasury bonds through central bank, saying the face value is 100 rupees, but I am going to give you a discounted price, maybe 90 rupees. If the treasury bill is with the 6 months maturity, then after 6 months, you will go and give this back at maturity, you will get 100 rupees. So then your margin is 10 rupees. That is your income, or that is your interest, or that is your yield to maturity, right? So you can think this formula with that example. For any 1 year discount bond, I always take it as 1 year, because like if you are going with the 3 months, 6 months, a little bit complex. I just want the interest rate, right? Okay, so then interest rate is equal face value minus price divided by price, right? Now face value is 100. You are going to buy it at 90 rupees. So then 100 minus 90 divided by your investment, that is your price, 90. So when you invest 90 rupees, you will get 10 rupees income. So that means your interest may be 11.1111, like that. You have to calculate and see, right? More than, because if it is 10% is 9 rupees, now you are earning 10 rupees, right? Maybe 11.11, something like that. So here, when you want to calculate interest on discounted bond, this is the way. The final type of financial instruments, when you calculate interest. Now again, go back and see. You are a household. You may give a simple loan. You may give a fixed payment loan. You may give kind of coupon bond, right? It does not mean necessarily you have to always think about treasury bills and bonds. It may be a private bond, coupon bonds, or you can have a discount bond, right? Something like that. So you should be able to know at what interest rate I am going to work on. Or if you are an investor, if you are going to invest on these, you should be able to know what is my reward. Or if you are a consumer, you should be able to know what is my cost of borrowing. And overall, you should be able to, finally, whatever happens, you should be able to link what with what. So you are going to link today's, that means present value, to the future value. This is what I told you earlier. The interest rate will have a function of 3 mainly. Link present value to the future value. It's talk about the rewards for the investments or cost of borrowings. In all the scenarios, you should be able to understand with these basic instruments. So here also, yield to maturity equals the increase in price over the year divided by the initial price. This is I is the yield to maturity. Here also always negative when the yield is changing, right? The yield to maturity is negatively related to the current bond price, right? When the yield to maturity is increases, your bond price will be decreasing. Okay, up to now we have seen what is interest rate, how that works, right? And for different instruments, how we are going to see it's a cost of borrowing changes or like rewards, or how we are going to link between future and present values. Is that okay? Clear? Any doubts on that? Okay, so now I think you are clear on that, right? I didn't give complex examples and all because that is not the scope of these discussions. Just to give hint around the interest rate to understand. It's a gravity with, you know, all other instruments. Okay, so the next area is the distinction between interest rates and returns. Now, most of the people think, okay, interest rate is my return, right? Now you are thinking, okay, you are investing on shares, right? Normally, what is your return or what is your interest rate in that sense? Or like your regular payment, what would be for shares? Anybody? When you invest on a shares, you will regularly get what?
Dividends?
Dividend. Very good. So you will get dividend. So when people think, okay, I'm getting dividend, this is my return. But in addition to that, there would be something else as well. That is the gain, capital gain. So when you calculate the return, you not only talk about the dividend or interest payment, but also you have to include the capital gain as well. If you take your bond, the coupon you will be getting coupon anyway. So then let's assume now the bond price is 100 rupees. You are getting coupon continuously. At end of the, you know, like end of the maturity, anyway you will be getting the face value. But before the maturity, sometimes you may be selling that bond for an additional price. If you sell that, let's assume you have bought it for 1,000 rupees, but you could be able to sell it 1,100. Now you have additional 100 as well, in addition to the coupon. So when you calculate the return, you should be RET is the return. You will get first coupon, that's a present value of the coupon, right? So then your additional capital gain as well. Actually, this is not the present value I'm talking about. This is the yield rate I'm talking about here, right? C divided by coupon divided by price of your bond. That is the yield rate. And then what is the percentage you are earning from your capital gain? So today's PT means today's price. PT plus 1 is today plus 1 tomorrow's price. That is the price difference. You take the price difference and divide by the today's price, you will get the capital gain percentage. I'm using the capital gain as a word to understand you all, right? So that means the difference between the today's price and tomorrow's price, right? So this, if you add these two components, you will get the return. Now let's assume this yield is 5% and capital gain is 2%. So your return might be 7%. So now you should understand the interest rate is different and the yield rate is different and rate of return is different. When you say interest rate, that is the coupon rate, right? When you say yield rate, that is, subject to this calculation. Finally, what is the yield to maturity? That's a yield rate, right? Or third one, rate of return. That is, you put together and calculate this. Up to now, is there any question? I hope you all are clear on that. Just think about with the examples and see. If you read this, the essence of this idea, you could understand if you are clear on the calculation especially, but without that even, if your concept is clear, you will have this findings, conclusion on this. The return equals the yield to maturity only if the holding period equals the time to maturity. Any question? Somebody wants to ask any question? No. Okay. Now the problem comes, if you are going to keep this, your financial instruments or treasury bonds until the maturity, right? You don't have any issue. Your yield to maturity would be equal to your return, because you don't have any price difference, as I said here. Today's price and tomorrow's price, because like you are going to have it face value anyway at the maturity, right? So if you take right, any bonds, like you might have take a bond, 100 rupee bond. If you buy it at a primary auction, it's 100 rupee, and end of the tenor you are going to get again the same face value. So you don't have that issue, right? So if you keep that bonds until the maturity, then your returns equals the yield to maturity. Right? Clear? And second sentence, a rise in the interest rate is associated with a fall in bond price. That you know. When the interest rate rises, bond price will fall, resulting in a capital loss, right? You will have a capital loss. That means price loss. That means like value, right? Price of that bond, maybe face value is 100 rupees, means now it's 80 rupees, maybe, right? Resulting in capital loss if time to maturity is longer than the holding period, right? So maturity is maybe 5 years, but your holding period is 2 years, so you are going to have the loss, right? These are in additional interpretation. You have to keep in mind this first line. Others are following through. I'm just asking you all, are you all following me or just listening to me or thinking, okay, we can look into later? Chaminda, is that okay?
Yes, sir.
Good, good. Actually, like, this is not a kind of rocket science. Sometimes you may be able to catch up when you forget the calculation. That's it. If you can just try a calculation, it's nothing to, nothing difficult to understand. So it's another explanation. The more distant a bond's maturity, the greater the size of the percentage price change associated with an interest rate change. Okay, it's simply, I will explain with the example, right? You could see here. Look at this example. Distinction between interest rate and returns, I would say here, table 2 examples. 1 year return on deferred maturity, right? 10% coupon rate bond. The bond is 10% coupon rate, right? Now we are going to see when the interest rate rises, rise from 10% to 20%. See this example. Now, first column, years to maturity when bond is purchased. You are purchasing a bond. The years to maturity, the one may be 30 years, other one is 20 years, other one is 10 years, other one is 5 years, other one is going to mature in 2 years, other one is going to mature in 1 year. So let's assume you bought 1, 2, 3, 4, 5, 6. 6 bonds with different maturity, remaining maturity. Different remaining maturity. Now you can see the coupon rate is 10%, right? Okay. Now the interest rate, initial current yield is 10%, right? You mentioned all the bonds are 10%. So initial price, you bought it for 1,000, all are $1,000 worth of treasury bonds. Now the question is, what will be the price of these bonds next year? That is the question, right? Now you can see this is remaining maturity is 1 year, right? Initial current yield is 10%. Initial price is $1,000, right? You will get coupon 10%, right? So then at the end of 1 year, you are going to get this price, right? Initial price, right? And this coupon rate. You are not going to lose anything, and your rate of return is this 10% exactly. Why? This is the 1 year's time, nothing changed, because remaining maturity is 1 year, right? But the thing is, if you have 2-year maturity bond, you are going to discount for 2 years. Why? Now it's earlier it was 10%, now it's 20%. You are going to discount by 2 years by 20%. Then additional 10%, right? That means 20% now. Then your price for the next year will be every time that will be discounted by number of years. You all could remember now, every year we will be discount by additional years. So when you discount, this price will be less and less and less when the remaining maturities increases. So when the price going down, the rate of the capital gain, you can see it's a loss minus increasing. So your rate of return, that is inclusive of this initial current yield coupon rate with this rate of capital gain loss. So then you will have this kind of losses. So here you have to keep in mind, when the remaining maturity increases, you will have accumulated losses. When the tenure is going up, remaining maturity is going up, you will be accumulating more losses. That means the remaining maturity and the return, you will have negative relationship, that is more, we will call it more prone to volatility. This what if you go with treasury guys, right? So in other terms, when we explain, we would say more uncertainty, right? Possible losses are increasing when the remaining maturity is higher. So those are the explanation, embedded in this kind of analysis. But even calculation wise, we are discounting more and more. That's what I say. More distance of bond maturity. When the distance of bond maturity increases, the lower the rate of return that occurs as a result of an increase in interest rate. Right? When more distance, you will have, more impact on your rate of return because interest rate increases. In simply saying, now the Sri Lankan interest rate increasing, you can have two bonds. One is with 1 year's maturity, remaining maturity. Other one is 10 years remaining maturity. So the 10 years remaining maturity bond will make more loss compared to this 1 year remaining maturity bond. This is the conclusion. I think you could understand. I'm just going to ask you all, is it clear? Dilshani. This is where the bank's assets and liability management, ALM, in your banks, you will be having a committee called ALM, Assets and Liability Management Committee, right? Their job is to manage the assets and liabilities. They should be able to discuss and recommend to the board of directors, okay, so we can invest on these treasury bills and bonds. If they can recommend like that, okay, what is the tenor? That's the next questions. So you have to focus your, interest rate trends, and you have to just to see with the globally aligned analysis and see, okay, we are just tend to think okay, the interest rate will increase. So interest rate will increase. That's what we bring those stress testing as well. You have to do kind of stress. Okay, when the interest rate change from 10 to 20%, what will be the loss to your portfolio? So then you have to immediately change your, tenor or risk structure of your treasury bills and bonds and all other financial assets. So this is the big work of this ALM committee. I don't know whether all are doing the perfect sense, but that is the key. For that kind of all analysis, you should be knowing the interest rate in detail. Gavin, is that okay?
Yes, sir.
Okay. Maybe a little bit, if you are not going to that detail in your office works, so maybe sometime difficult, but this is kind of straightforward, right? Just read it again and see based on these examples. Even if you lost during the class, I think when you read it again, you can catch it up, right? If you don't or still need my help, of course, you are so welcome, right? Okay. This is what I explained to you: maturity and the volatility of bond returns, interest rate risk. Okay. Can anybody tell me what are the risk bank is taking? Shall I ask one by one? I think bankers are very talkative, and this class is so silent because of virtual class might be, right? Even sometimes I don't need to talk in the class because somebody will ask question and others will answer the questions. I'll be a little bit free. In a normal physical class, this class, right, maybe a little bit tough for me as well. And rather, why don't you say something on that? Anyway, I will be asking you continuously because your name is on top. Give me a one risk item the bank is facing.
It's a credit risk.
Very good. That's a major risk, credit risk. Chaminda, second one.
Market risk.
Yes, market risk. Dilshani. Credit risk, market risk. One more. Dilushi Bandara. Or Gavin. Okay. Okay. Let's go. Otherwise, I'll be losing time as well. So when you say like, okay, we'll be having so many risks, right? In a banking business. So one is credit risk, right? That is possible losses arising from the defaults, right? That's one risk. And then market risk. Shaminda, what do you mean by market risk?
Customer segment like that.
Sorry, I didn't get it.
Customer segments, certain customer segments. Portfolios.
I think not really. Anybody else? Okay, so then when it comes to this risk, actually banks are having so many risks in their profile. One is credit risk, market risk, operational risk, liquidity risk, or legal risk, reputation risk, or strategic risk. So many risks they involve, right? Taking activities they involve. But basically in Sri Lankan context, we take it seriously, like credit risk, market risk, liquid risk, and operational risk are very serious. And out of that, credit and market, of course, credit is the number one, and market may be significant. And over and above, liquidity risk also serious one, right? Because liquidity risk bring all other risks together, right? Something, even though you may be very strong bank, less credit risk, less market risk, less operational risk, but your liquid risk is high, definitely you will bring all the risks together and it will lead to a bankrupt or collapse, right? So in that context, liquid risk is higher, but in the sense, like overall portfolio basis, credit risk is the kind of major risk for the Sri Lankan banking sector. So when it comes to market risk, what do you mean by market risk? That, hold on for a while. Just you can think for a while. Okay. The market risk means like the possible losses arising from the changes in the market price. There is a definition for market risk. So if you take that definition, what are the risks we can consider? What are the factors we can consider into that market risk? Anybody? Come on, you have to speak. 3 hours lectures continuously. Unless you don't speak, we can't follow, right? Even myself, right? Now I have told you, right? Okay, these are the risk bank is taking, and one of the major risk factors is the market risk factors. So I have already told you what is the market risk, and I'm just asking what are the factors you can consider into market risk. Mainly 3 factors we should look into as a banker. In your bank, when you say market risk, even if you go through annual report, you could see what are the areas they talked about. Come on, somebody should speak.
So something like interest rate is?
Exactly. One is when you take market risk, one of the component is interest rate risk. The second one,
Exchange risk.
exactly, Rangana. Second one is exchange rate risk. Third one,
gold price.
Visista, yes, gold price, one of the examples, we call it price risk. That can be gold as well, right? So any contract that involves price, of course, price risk. So one of the example is gold price. So Sri Lankan banking sector, we talked about normally gold price, right? Okay, and also share price, right? So we call it price risk. So it can be shares, it can be gold, right? Okay, very good. So when it comes to interest rates, we would say, okay, there's a possible losses arising from the movement of interest rate. And similarly, like when it comes to foreign exchange, we usually talk about possible losses because of the volatility in foreign exchange. That's a foreign exchange risk. And price risk, we talk about like possible losses when the prices are so arising from the price changes. Maybe share price, when it goes up, you earn. When it comes down, you lose. Like gold price, you have gold, right? Banks, every bank has their own stock of golds. When the gold price increases, they are gaining. So when it's coming down, they might be losing. So these are the 3 major categorization of the market risk. Here you could see what I am talking about, which risk I am talking about, interest rate risk, right? Here in previous example, you could see, now you see this table 2, I explained when the interest rate rises from 10% to 20%, what I'm talking about here, this is the interest rate risk. So when the market interest rate changes, your portfolio is going to affect it. When you have this bond with you, if it is 1 year bond remaining maturity, then you don't lose anything. But if you have a 30 years remaining maturity, you are going to lose 50% of that bond value. And this is the market risk. That means interest rate risk you have. Right? So treasury's function, you could see like there are, if you take your corporate governance, I just wanted to bring those also because that will give you kind of a real life experience. Otherwise, if I go with all these theories and all, you also will be losing, some kind of course, interest on this subject. So I'll just bring some other element also from banking experience. So you might be having in your corporate governance strategy, okay, you have board of directors. Under that board of directors, we have so many committees. One of the committees looking after interest rate risk, or like all the risk involved with the bank. Or what is the name of the committee? Anybody?
Assets and liabilities committee.
That's a management level committee. You are right. What I'm asking is next to the board level committee. First board, if you see the corporate governance of a bank, first the overall responsibility is attached with board of directors. Then below that, they will have some board level committees, right? Maybe nomination committee, right? Or maybe board audit committees. So there should be a risk related committee as well. What's the name of that committee? Anybody? I'm going to ask individually which bank you are working in and what's the role of your. Normally in physical class we discuss everything, right? I don't want to, in a virtual class, like I don't want to discuss all these things, because like I know like whoever having different role to do that. So sometimes you may not be knowing, but definitely as a banker you should know that.
So risk management committee?
Yes, you're almost there. We don't call it risk management committee. We call it integrated risk management committee.
Yeah.
That's a board integrated BARMC, board integrated risk management committee. Very good, Anuradha. So that's a second board level committee. Then when it comes to like management level committees, so you can have risk management committee, or like as I think Chamindo Rangana said, okay, assets and liability management committee. So actually like assets and liability management, they look into the management part. Basically a separate committee would do for risk management. So they will look into that, and they will have all these calculations once, like, I don't know, sometimes you will get a chance to join with this kind of committees. So then when you join this kind of committees, you should be able to, you should have all the in and out ideas about this interest rate risk. In this example, when I say like you might not got that kind of ideas, but this is what we call it interest rate risk. Now, when it comes to interest rates, so then board integrated risk management committee, board level committee, and then the management level committee, that is a risk management committee or assets and liability, or maybe sometimes treasury middle office. Also, they used to have this kind of analysis because they are more into check into this treasury functions or middle management, so in the sense risk management, right, part. So here the example of that, when the interest rate moving from 10% to 20%, your portfolio will be losing by 50%. The huge loss. If it is 1,000 billion, or like, okay, 1 billion, you will be losing a 500 million worth of value. So you have to book a loss of 500 million. It may be huge for a medium-sized bank, right? So this is what I call it interest rate risk. So here, what we are saying is the maturity and the volatility is very important to analyze. And when the interest rate is volatile and the remaining maturity is having a longer tenor, so you will be having more risk, right? So prices and return for long-term bonds are more volatile than those of short-term bonds. You could see from this table, right? If you see this one, short-term tenor, remaining maturity bonds are less volatile. But if you take longer tenor, it's more volatile, right? And then there's no interest rate risk for any bond whose time to maturity matches the holding period, right? That's what I said. Now, if you are going to keep it until the maturity, that's what the meaning here, the whose time to maturity matches the holding period. So let's say time to maturity 5 years, and holding period also you are going to hold until the maturity. That means 5 years, no risk. That's what we don't make any, because we will get the face value, right, at the end of the day. So we don't make any provisions, any impairment. We don't book any impairment if the bond is going to be held in a banking book or held unto maturity, right? So is that okay? Or any other practical things even you come across, you can discuss, maybe more interesting sometime, and more those are things you will carry end of your banking career at least. Okay, these are things we have to think of, right? I think you're okay with that, so I can move on to next. Up to now, any doubts? So each and every slides we have some kind of concept. You pick those concepts. That's what I want. And you can remember and you can practice at every time when you come across. Now, there's an important idea, theoretical idea. That is, you have two kinds of interest rates. One is, we call it real interest rate. Other one is, we call it nominal interest rate. Right? So this is very important at a later stage as well, every time when we talk about. Now, up to now, we have seen, we have understood what is this interest rate, why we need interest rate, and what are the circumstances it, kind of work in different ways. And we call it interest rate, we call it yield to maturity, we call it a return, right? So many interpretation with the different perspective we have learned. And finally, one of the kind of theory, right, the distinction between real and nominal interest rates. Up to now, we have seen kind of interest rate. When you say interest rate, that we assume that is the nominal interest rate. That means a monetary phenomena. What is the interest rate you are going to give this fixed deposits? What is the interest rate you are going to give it for treasury bonds? What is your coupon rate? Those are nominal interest rates. So now the question is different. I am asking you all, I'm going to ask one by one now, right? Again, I'm going to start with Anuradha. Okay, you are a banker. Will you advise to your customer to come and make a deposit in your bank now? Anuradha? Yes or no? And then the reason. Anyway, if you are a banker, definitely you have to say come and deposit. That's a different story. But from your heart, what do you say? That's a business anyway. From your heart, what are you going to say to the customer?
Yes, since the deposit rates are somewhat lesser than the previous time period, by my heart, I don't ask to have a savings deposit even, because now it's nearly 3%. Automatically, but they tend to have FDs rather savings. But in the FDs even, the rate is somewhat lesser.
Yes. Okay, if that's good, correct. Now, if I ask you a question like, okay, is it nowadays, is it go for consumption rather than serving? What do you think?
Yes.
That would be your advice. Then don't come for deposit. Just buy stuff and enjoy your life. Right? No, just this is economic terms we are discussing, not the business point of view. Right? Okay, very good, Anuradha. I agree with your point some extent. Oh yeah, oh fully. Okay, what do you think, Chaminder? What do you say?
It is better to do short-term deposits.
Better to do so. Why is that?
In customer side.
Yeah. You think that deposit rate will increase later?
Yeah.
Okay. Now, Dilshani, you have anything to say?
So I would also say not to deposit in a bank, but rather invest in something like or deposit in something like a mutual fund, where they take several people's investments and invest in something like government securities, because the bond prices are going up. So I think that would give much better return, something like that, rather than deposits in bank, which are really low, like fixed deposits and savings account deposits. They give a low rate of interest, but there are other options out there that give a rate higher than that you get in the banks.
Mm-hmm. Yeah, you're right. I believe you are working for a mutual fund then.
Yeah, I'm working at First Capital.
Oh, you want? Okay, it's a good idea. Yeah, fine. Okay. Then Gavin, yes, I agree with Dilshani's point. Gavin?
Yes, I would also not recommend to do any investments in banks. We could go for like other investment options.
Good. So then, Rangana, you want to say different stories out of this?
Actually, I agree with the earlier idea of investing for a short term on banks with the expected rate hikes in time to come. So, for the time being, to invest in short-term deposits at branch, not to go for long-term deposits.
Good. Now you all are just discussing about the tenor of the deposits, right? Which one to? It's like an interest rate risk we saw. Like this, what exactly what you're saying now. Here in this table, okay, don't go to longer tenor because your loss may be higher. Go for a shorter tenor. Now, without this, maybe you may be having the idea, but without this idea, even you should be able to, with the practical sense, you should be able to tell those. But the idea behind is this, right? Exactly. This is what we are talking about, the tenor, when it comes to tenor. Yes, 100% agreed. And then Vidura, you want to say anything? You want to add anything onto this?
Yes, we can invest on fixed assets.
Fixed assets, mean real assets you're talking about.
Yeah, real assets.
Okay. Only thing is, like, to invest on real estate, you need a lot of money. That's the only thing, right? Okay. Visista, what do you think?
I also agree on short-term deposit because little by little interest rate is going up. So we can advise the customer to put in short term.
Okay, good. I agreed all your point. There's no wrong point. Actually, everything is correct point with different perspective. But I couldn't see a one option out of all these discussions. I was expecting that one, right? Now, I feel personally, no, not in the sense I can't say like that. There's another option as well, right? In the sense, but we discussed that. I also can encourage people in the sense, It's not going to happen anyway. I'm not going to do that. Just I'm telling, sake of having this kind of argument, right? Oh, don't save, man. Go and have a nice dinner, relax, enjoy your life for some time. Spend your money. That's what I would do, right? Why I'm saying is, now, as everybody said, deposit is very low, right? How much I'm earning? Maybe 3%, 4%, right? Or even other one, maximum 5%, 6%, right? That is 6%, right? So that means, okay, if I have 100 rupees, I will get 106 rupees after 1 year, right? I save, I forego my consumption, I serve it. After 1 year, I will get 106 rupees. And I go to the market, that time I want to buy a shirt. Today, a shirt is 100 rupees. I don't want to buy that. I don't want to consume. I thought, okay, better to serve and buy a very good shirt. I go to the market after 1 year with 106 rupees. Will I be able to buy a good shirt or same shirt or bad shirt? Just let me know.
Bad shirt.
Definitely I am going to lose by saving. Why you are saying that? Rangana implied that means
Inflation.
Exactly. Your inflation may be far higher than this interest rate. Then you are getting negative return. Even if you think, okay, I'll go for a short-term deposits, and this is just for a theory, right? Don't expect like central bank is saying like that. That is different, right? Central bank is different. This is, I'm just telling you for sake of having some argument. Even you have a short-term deposits, and when the times to come, when the deposit rates are increases, sometimes inflation also may be increasing. Who knows? Again, that point even onwards, even that point as well, you will have negative kind of real interest rate. So negative kind of, purchasing power. I don't go into that like economic terms, because that's what I'm going to explain to you, right? You will lose purchasing power again. Even you go for a 10%, sometimes who knows, you may lose it. So for me personally, I could see, okay, better to enjoy, buy a shirt now rather than next year. Keep it for a while. That's okay. Buy electronic items today, or build this house today, right? Or just have a meal, very good meal today, right? I tend to buy today rather than saving and buy it day after tomorrow. So what I'm literally speaking is, the nominal interest rate today may be 3%, but your real interest rate, your real return actually may be negative, right? Can you all hear me? I just dropped.
Yes, sir.
Okay.
Yes.
So now, what is the inflation? Can anybody tell me? Latest one, latest figure. Even I couldn't see that latest figure. Maybe assume 7%, just for sake of having this one, right? So because there are different core inflation, different stories are there behind, right? So let's assume a 7%. Now you have 7% inflation rate. That means prices are increased by 7%. But how much you are getting from the fixed deposits? 3% or 5%. Let's assume 5% max. So 2% you are losing. Prices increase by 7 rupees, but your interest increased by your kind of wealth is increased by only 5 rupees. You are going to gain lose 2 rupees. So this is the area where you talk about nominal interest rate and the real interest rate. Even though the FD is at a 5%, is a nominal interest rate is 5%, your real interest rate is minus 2%. Because when you deduct this inflation, you will have minus 2%. Your real interest rate is minus, means you are losing. There may be time like, okay, your FD is 10% and inflation is 6%, you are still making 4% real interest rate. That's of course okay, you are earning. Right? So this is the difference between nominal interest rate and the real interest rate. So always we should look into, when we fix this deposit rates and all, anyway, market is different. See this. Now these pensioners having deposits in the bank, they may be losing. If they lose, what will happen the next day? Tell me. Anybody? If they think, okay, the pensioners, they got to know, okay, this is what happened. So we are losing our money. What is the other alternative? Okay, they may go to finance companies. They will be giving 10%. Or sometimes the finance company's interest rate also may not be enough to him. So then he will be lured into, you know, some of the people in their hometown saying, okay, give me money, I will give you 24% interest rate. They will give the money. Then finally, ultimately, they will lose their money saving as well. This is what happens, right? Pyramid scheme, whatever the schemes, because people, something like, it's not a, you know, something limited to this kind of analysis. It's a broader perspective we have. So when we have the like interest rate, when we decide kind of interest rate, so many influences are there. We should see everything, and there should be a, you know, fair amount of understanding, fairness to everybody. So it's kind of different scenario when it comes to fixing everything. Now you might be understood what I'm talking about, I think. So the distinction between real and nominal interest rates, the nominal interest rate makes no allowance for inflation. So it's, if it is 5% deposit rates, it's a 5%. But real interest rate, what we are saying is, right, you have to deduct, when you take the real interest rate, when you calculate the real interest rate, take nominal interest rate and deduct the expected inflation. Right? What is the inflation? Expected. That means future inflation. Right? This equation called Fisher equation, because this is introduced by Ivan Fisher. So he says the real interest rate could be calculated taking the nominal interest rate and deducting from like, okay, expected inflation. If you see this formula, the nominal interest rate means I, the nominal interest rate equal real interest rate, that's IR, and expected inflation. Right? Now you can plug and see. Now deposit rate is, nominal interest rate is 5%, and then your expected inflation is 8% means, right? So then you bring this 8 this side, so your real interest rate may be -3. Right? So here what I have said is, when the real interest rate is low, there are greater incentive to borrow. So borrow, when the real interest rate is low, that's what now people are borrowing more. Even housing loans, everybody would like to borrow because real interest is very low. Borrower is very happy, but lender is not happy. Depositor is not happy, right? Because for real, like depositors, a real interest should be very high, but borrowers, this is the negative. So you can borrow as much as possible, right? Now, if you take, you can get a housing loan at 7% and your inflation is 7%. right? You're not going to lose anything. There's no interest for you, real interest, right? Okay, so if you see this graph, the real and nominal interest rates, these are the states, 3-month treasury bills, 1953 to 1970. It's basically from the book for understanding, right? Okay, so the blue color is nominal interest rate. You can see sometimes if you see this, the gap, estimated real rate, the gap you can see, that means what? In this range, the inflation is very high in US market, right? Sometimes those countries inflation go negative as well. Now, if you see this point, 2010 or somewhere, like really is higher than the nominal. Sometimes even you can see the Japan and all, they have negative nominal interest rate, right? Something like that. You could see, but you can see in this graph, okay, how that moves. It will move always like similar pattern, but when the inflation is uncontrollable or like exceptional case, then you will have this kind of, you know, graph. Okay, I think the first part we have done. As usual, I would like to finish in 3 hours time always, and then maybe, because I don't want to continue with 4 hours, it may be very cumbersome as a virtual class and giving breaks and all. I'm not comfortable about that for 4-hour class. I think you too. Okay, so I think the part 2 we can continue with the next class. Okay, if you have any doubts in understanding, in understanding interest rate or interest rate analysis, is that okay? All good? Rangana, is that fine?
Okay, sir. Okay, sir.
All right. Thank you so much then. See you in the next class.